Good morning everyone, this is Amit Pabari, founder and managing director of CR Forex. Let me show you an interesting data point between same asset class, what happened in 2018 trade war and 2025 trade war. In 2018, Chinese currency got weaker by 4.5%. This time it got weaker by 1.26%. In 2018, dollar index became stronger by 2.59%. This time dollar index became weaker by 5%. That time yield 10-year US yield went up by 2.6 BPS. This time it went by 18.9 BPS. This is showing that generally the trend is whenever some global event will happen, dollar will get stronger. This time dollar got weaker. Let us understand why. This data point raises three questions. Question number one, is the US economy facing structural issues? Second, is the global investor not preferring dollar as a safe haven? Third, in the trade war, is the US behind China? In today's presentation, let us decode that. Let me answer the last question first. Is the US behind China in the trade war? Let me show you an interesting data point. If you see the chart, you will understand that China was able to reduce its dependency on US export. At one point of time, it was exporting 26%. Today, it is only exporting 10% of its exports to US. Otherwise, round, if we see US imports a lot of intermediary goods from China. Their dependency has not reduced drastically. This is clearly showing that China is ahead of US in terms of export and import data points. Now let us understand what are the items where US import is dependent on China. I think games, consoles, laptop, iPhones, their dependency rate is 66 to 86%, which shows that they will not be able to easily move away from China. Apart from manufacturing, another area where US is dependent more on China is rare earth elements. If you see the chart, the entire world's 65 to 75% production of rare earth elements is happening in China. Now let us understand where these rare earth elements are used and why US is dependent on China. The importance of rare earth element increased drastically in last few years as they are used in EV, apart from that powerful computers and cleaner energies. Most of the materials are processed and mined in China, and over the years they have spent huge money on the infrastructure. Companies like Tesla and Apple are highly dependent on these rare earth elements. China knows the importance of rare earth element, because of which last week they have imposed export restrictions. In 2010 also they knew that rare earth elements are important. They put a restriction while exporting it to Japan also when they had conflict with Japan. So we can say that this is the trump card which China will use against Trump. Looking at US import dependency, it reminds me of famous Raj Kapoor song where he says that मेरा iPhone है Chinese, मेरी कार है Japanese, ऑयल आता है कनाडा से, फिर भी हार्ट है अमेरिकन, टीवी है कोरियन, शूज है वियतनामीज, everything I am importing, yet I am living the American dream. Now let me answer the second question which we have raised, that is the global investor losing faith in dollar? Now in order to answer that, we have two data points. In last few weeks, Japanese currency became stronger. Now in the entire world, Japan is the highest holder of US Treasury. After Japan, it is China. Last week, Japan sold US Treasury bonds like anything, and they have not subscribed for 10-year bond bidding which happened in the US last week. They have sold approximately 2.57 k billion Japanese yen worth bond, because of which 10-year yield shoot up higher and dollar fell drastically. Now let us conclude whether US is facing structural problem or not. I think we have discussed this data point many a times, but let me summarize all the data points. Largest wave of tariff in 100 years. Inflation expectation is very high. GDP is supposed to decline for next few quarters. Consumer sentiment is at pandemic level and stock market in bear territory. These are all indication that US is facing structural issue. Now all the data points are suggesting one thing, that dollar index, which is trading near 99 kind of a level, is going to continue to face pressure, and the major trend is on the downward trajectory. In the short term, it can bounce back towards 102 to 104 kind of a level, but the major target which we have given earlier of 97 to 98 remains intact. Now let us discuss the outlook on rupee. Generally, when we determine the view on rupee, we see domestic factors and international factors. In domestic factors, growth, inflation is intact. On the global factors, dollar index is on the downward trajectory and oil is also under control. Only one challenge which we might face is weaker Chinese currency. Last week, Chinese currency went and made a high of 7.42. It moved from 7.20 to 7.42 kind of a level, although it closed the week near 7.28 kind of level, giving a breather to all Asian currencies. If Chinese currency gets weaker, it can put pressure on dollar rupee pair. Technically, 8640 to 8650 is going to act as a very strong resistance for rupee, and ideally the pair should move towards 8550 in coming days. Now let us discuss strategy for exporters and importers. Before we discuss that, let me give you a data point. If you see the chart, you will be able to understand that in the month of April we have got 86.70 also, and we have got 84.96 also. It shows us that volatility is going to be there with the trade war. So it is important that rather than predicting the view, we should focus on hedging our exposure in a right direction. Strategy for exporters will suggest that between 86.20 to 86.40 kind of a level, they should increase their hedge ratio. If anyone wants to wait, they should keep a strict stop loss of 85.80 kind of level. If 85.80 is broken, they should simply go and hedge. Now let us discuss strategy for importers. For importers, we will suggest that they can keep a strict stop loss of 86.25 and wait for lower levels of 85.60 to 85.80, where they can cover 50% of their near term imports. Near term means 30 to 45 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.